Airbnb reported earnings today and the stock dropped 7%, taking the company's market cap to $96 billion, with $11 billion of cash and investments on its balance sheet and $2 billion of long-term debt. The enterprise value is $87 billion. Revenue over the last 12 months comes to $10.2 billion, with $4.9 billion of net income and $4.2 billion of free cash flow. That means Airbnb stock is valued at just under 20 times earnings and 21 times free cash flow. However, Airbnb's net income is inflated by a one-off tax benefit in the third quarter of last year. Account for that and trailing 12-month net income falls to $2.2 billion, which takes the PE ratio up to 44. All in all, Airbnb delivered a solid first quarter with 18% revenue growth and a 20% increase in free cash flow. Gross booking value on the platform increased 12%, while the number of nights and experiences booked increased 10%. The company also bought back $750 million of shares, which helps to offset stock-based compensation. A new Icons feature allows customers to experience unique stays, such as a night at the Ferrari Museum or a night in a Pixar Up house. This is a smart feature that should drive word of mouth and further elevate the Airbnb brand. In addition, Airbnb is getting ready for the upcoming Olympics, and it saw a 60% increase in app downloads. Management said that this was due to a renewed focus on the app, which drives more conversions than the website. On the negative side, Airbnb provided a modest guidance for next quarter, expecting 8 to 10% growth in revenue and flat bookings. And although Airbnb reports healthy free cash flow, some of that comes from forward bookings, which is yet to be taxed. So free cash flow margins of 41% are probably overstating Airbnb's true earnings. In fact, although the company has reported $4.2 billion of free cash flow, only $1 billion of that has made its way to the balance sheet. To value Airbnb, let's assume the company is able to grow its top-line revenue 12% a year for the next 5 years and then operate with a 30% net income margin. In that scenario, net income in 5 years' time would be roughly $5.4 billion. Apply a 25 times multiple to that figure and the valuation gets to $135 billion. Assume that buybacks are used to offset share dilution and the annualized return works out to about 7% per year. Airbnb is a great business, but there are signs that the business is maturing, with slower growth and a high penetration among its key markets. As a result, the company needs to significantly boost its growth rates to justify the current price. But these are my personal opinions, not financial advice, and I hold no position in Airbnb. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.